Palantir has become one of the most talked about stocks in recent years. Positioned as an AI and data analytics powerhouse with deep government ties, the company has attracted both retail traders who view it as the next big tech giant and skeptics who call it overhyped. But one fact is hard to ignore. Palantir insiders have been aggressively selling stock, often at a pace that exceeds the company's own revenue generation. Since its direct listing in 2020, executives and early investors, including co-founder Peter Thiel, have consistently unloaded shares. The first 2 years after going public, insider sales crossed several billions of dollars, while annual revenues at the time were still in the low billions. Even recently, as Palantir crossed the $2.2 billion mark in annual revenue, insider selling remained elevated, raising eyebrows among investors. So here are the eye-opening insider activity. First person unloading shares, Alex Karp. So last week, Karp sold over 400,000 shares worth more than $60 million, at prices ranging from $142 to $157 a share. A move he describes as covering tax obligations from investor-restricted stock. This recent sale adds to the broader trend. Karp has sold nearly $2 billion worth of stock over the past 2 years. Earlier in the year, he also submitted a plan to sell up to 9.975 million shares by mid-September, potentially netting close to $1.2 billion based on prevailing prices. And then there's Stephen Cohen, who's the co-founder and president. Cohen has also been active. In February 2025, he sold approximately 301,847 shares at around $102 a share, plus additional sales totaling $38 million across adjacent days. In March 2025, he made even larger moves, selling over $310 million in stock, which represented about 23% of his total holdings under a prearranged trading plan. So why does this matter? Palantir's annual revenue for 2024 was $2.866 billion, meaning the insider selling is not just large, it dramatically overshadows the company's year-over-year top line. When investors collectively offload such staggering sum, it raises red flags about their confidence, or at minimum signals peak valuations are being locked in. Critics argue that Palantir's culture leans more towards monetizing equity grants than driving shareholder value. Supporters counter that much of that selling stems from the company's heavy use of stock-based compensation, which insiders naturally convert into cash. What makes this situation especially interesting is how it contrasts with the bullish narrative surrounding Palantir's government contracts and expansion into commercial AI. The company pitches itself as indispensable to US defense and intelligence, and as a leader in enterprise AI adoption. Yet the people closest to the business, its founders and executives, are regularly reducing their stakes. For investors, the question becomes, is insider selling simply a byproduct of compensation practices, or a warning sign that Palantir's growth is already priced in? History has shown that while insider selling doesn't always spell disaster, consistent heavy selling can gap investor enthusiasm, particularly in growth stocks. Palantir's long-term success may still hinge on whether it can turn its government credibility into large-scale, profitable commercial adoption. Until then, insider sales will remain a shadow of the bullish AI narrative.